Okay.
Hello, everybody. One more introduction. I'm Julie with Old Capital. We're a little late on the recording, but we're always happy you're here. We're listening to Tim. He's going to share with us something he's working on.
Yes, just give me 1 second. I'm trying to bring it up.
Nate, you're awesome. So while you're doing that, Tim, I want to see, hold on, Tim, I just want to say hi to Nate. Nate always shows up an hour later. He's finally got his clock set.
Right, I finally got my timer on point.
Well
I went and bought this egg timer.
Well done.
Yeah, efficiency is the key.
Well, yeah, I'm glad you're here.
Yeah.
So Tim, you're on.
Okay. So can you guys see what I have on the screen?
Yep.
Okay. So it's a slightly different model that you guys used to. I wanted to try it out. It's a simple analyzer. So we don't have all the financials yet, but through CoStar, I was able to pull up some basic information. So their current average rents are at about $1,070, and it's 264 unit property. We know approximately the occupancy, but I actually tried to underwrite it with 90% occupancy, just for the heck of it, just to see what kind of numbers we can get out of it. So the next thing, I estimated the income growth at 1%, and as we don't know exactly how many units we're going to be able to turn over, I projected we're going to increase the rents to about by $40, because their submarket is showing to be at about close to $1,200 a month averaging. Now, one thing I wasn't sure about is the operating expenses. So I know properties at that scale usually operate at about 50% operating expense if you don't use your own property management company. And was wondering if you guys seen anything different. So currently I have it at 50%.
I've seen it less than that. The larger the properties, I've underwritten a lot of larger properties for some syndicators, and the expenses are typically less because the economies of scale and your management fees are less. They're usually like 3%, and there's usually more efficiencies with these larger properties. So I think 50% is high for a 264 unit. Not seeing the P&L, like if you showed us the P&L or showed us like what the expenses look like and the ratios and stuff, maybe we could get a better picture. But I think. Hey,
what metro is this in?
It's North Carolina.
We're in North Carolina.
Charlotte.
Charlotte. Okay. Yeah, so I mean, 50 to 60%. I'd say Charlotte's probably averaging 50 to 60%, depending on what class. 55 is probably pretty close to where Charlotte's at right now.
Even for that size,
yeah.
The size of the property and the amount of.
Yeah, well, it depends on a lot of things. I mean, if obviously if it's a stabilized property, your expenses are going to be a little lower. As an overall percentage. If it's not a stabilized property, the expenses are going to be higher. But for stabilized properties in Charlotte, you know, we're seeing things 50 to 55 in general. South Carolina, you know, 40 miles south of that, you get a different state with different taxes, and we're looking at 55 to 60 overall.
I would agree with you, Brian, on that. We are seeing with the taxes and the insurance, we're seeing huge increases in the expenses. So, you know, I would say more like 55.
Yeah.
Mm-hmm.
What does your co-star say?
The CoStar does not specify operating expenses.
Yeah, it does.
One more thing with operating expenses is if the utilities are included or if it's sub-metered, that's going to throw your operating expenses off. So basically, with what you have showing, it's really hard to give you feedback. You need to put a P&L or something more than
right. Yeah, this is right. So currently, this is just for a simple analysis, just to see if it flies, if this deal even flies. We don't have the actual. We don't have P&L. We don't have rent rolls yet. We just have a little bit of information about it, and that's just doing some preliminary analysis on it, just to see if it falls anything close to what the seller wants to get for it. Also threw in some renovation costs at about $500,000. It might be actually higher, but if we get close to the actual numbers, then I'll just fly in and take a closer look. The closing costs. So typically, yes, they're between 5% and 6%, and I was just wondering if you've seen anything different on that.
Brian, what do you usually estimate? You know, it just depends. I've seen, 30. It just depends, because you're talking about taxes, you're talking about insurance. I've seen as low as 3% and as high as 10%.
Okay.
So I would say, you're in the middle, so you can work from there.
Okay. Let's see. So yeah, we got. I got some not such great numbers on it, just based on a couple of the financial details, and these are all mostly our estimates. Now, Julie, what current rates have you actually seen in the past week? Are they as low as about 3.5, 3.2?
I've seen 3.3. I've heard bank rates at 2.98. It just depends who the operator is going to be and net worth. And, I think 4 is going to be a very conservative number at $28 million. Yeah.
Okay, that's perfect. So, and the exit cap, I believe the entry cap is about 5.3, and I estimated the exit cap to be about 6.5. What do you guys think in terms of North Carolina's 5-year, 7-year hold? Would that be a conservative number, or this is just I should go maybe even less than 6.5 exit cap?
I don't speak to exit caps, but Brian, are you still on?
You're probably safe with that. Like I've been.
Right, I was on mute. I had a very, very wonderful explanation for everybody, but Charlotte's cap rates right now are a little lower than the rest of North Carolina. I mean, it's a very stable market. So I think the economy in Charlotte is good. I think the projections in Charlotte are good. I don't think you're going to see as much cap rate growth as you would in other areas if there's a change in the economic winds. So you said you're saying 6.5 on exit?
Yes. So I saw a few properties. One was just purchased recently at about 4.9 or something like that. And the other 3 were purchased maybe a month or a couple of months prior to that, also in the vicinity at about 5.3.
See, you're at 106 a door. What is this, B-class asset?
Something like that, yes.
Okay. All right. Yeah, I'd say cap rate is 6.5 at exit is conservative. I may even push it down a little lower, but it depends on exactly where this is at.
Okay.
But just looking at 106 per door in Charlotte is probably B class, depending on where it's at.
Okay. And I heard somebody just mention that CoStar does show information in terms of the operating expenses.
Yes, it does. That's what I know because I have CoStar. I'm a commercial agent. Sometimes I use it.
All right, then I guess we'll get offline and I'll ask you to show me where it is because I can't remember off the top of my head right now that seeing a place where it actually showed.
No problem.
All right, you guys, I do want to wrap this up and get Mark on the line to see if we can continue on with our OM SDA. So there he is. Mark's back. Gary is in the house. Before we go any further, Gary needs to tell us how it is going. Gary closed last week. Gary and John closed last week on their 48-unit building. How are things?
Things are going good. We closed
anything that's happened over the last 4 days that you want to tell us was like, oh my goodness, I didn't know that.
No, nothing too much. Right now, we're just making sure the utilities, the water, are all put into our name. Talked to the garbage company today to make sure that going to still stay there. And we're just meeting with the property manager tomorrow. He took a walk through today. Just going to get them set up with our hit list. We got 2 vacancies we want to get rented, and just kind of get them going. So yeah, it's.
They're still in honeymoon phase right now. I mean,
we are.
Yeah. The euphoria is still there, and they're just, high as a kite. So, congratulations. Congratulations.
Thank you.
Yeah, we're tracking that one for quite a while from a distance. So,
congratulations.
Just figuring it out as we go. We're looking to start spending a bunch of money. We're looking at a new sign because we're renaming the building. So, we got an estimate for security cameras. We're going to get cameras put up and it's all honeymoon phase right now.
So I'll tell you one thing, you guys were smart to push it this long because, closing as you're going into winter is hard to keep units filled. So our vacancy dropped a little bit. We renovated some units and haven't brought them online yet because, we renovated them in December and January, so if you probably picked the best closing date in the world, end of February, beginning of March, so that
we didn't choose it; it just happened to us. But
let's pretend no. Just you guys chose it. But yeah, hopefully you'll get immediate, bang for your buck when you put stuff in, when you put your capital dollars in. Like I said, we've got 4 renovated units that have sat vacant for 2 months now. So. Hopefully March and April. We got an offer on one or a lease on one of them signed today, but
yeah, we got new. The property management company has leases. I just got a copy today. We're going to review. We got to make sure we're ready to go because we're going to have some turnovers are happening every month. With a property like that. So lots of things to get into place, but.
Well, keep us posted, Gary. Keep us posted.
The markets have been good to us, as Julie knows. Going with Fannie was actually a blessing. We were, you don't know which way it's going to go, and just got fortunate that the market. Now's a good time to buy. I wish I had another one.
Yeah, that's true. All right. Well, you guys, I do want to get started with Mark. It is potentially Mark's last week with us, although he'll be coming in and being a guest again. But I think, Mark, we can wrap it up or maybe not. Let's make a decision today if we can wrap it up. Otherwise, we'll be here another week with Mark next week.
Yeah, I think we can wrap it up.
Okay, I'm going to ask Mr. Briscoe.
Yep.
Mr. Briscoe, can you mute that? Thank you. All right, Mark, you're on now.
All right, so let me share my screen here. This is the 4th week, right, Julie?
I think so, yes, yes.
4th week. So yeah, we've been doing this for 4 weeks. We went through, we looked at the market for this one deal. We dug into the SDA, put the numbers in, and now we're just going through we went through the business plan, put in all the rental costs, and filled in pretty much everything. Now we're working on tweaking the numbers and seeing where we can, see if we can put a LOI in and try to get to the closest strike price that we can, or closest number to the offer that we can, while making our investors some money. So let me
ask a question
here.
Can I ask a quick question, Mark?
Yes.
Just from last week, I just wanted to ask, when you're adding the other income to the P&L for
Yes.
year 2 and year 3, I know we're not supposed to kind of mess with things that are in black.
Yeah, that was the only way I could do it. Like, I don't know how to.
But it doesn't, I mean, as long as it doesn't break it, then
yeah,
I'll use it. But I just wanted to make sure that was okay.
No, it's not breaking anything, except it's adding, because I mean, there's really, it's basically what you see in blue is what you can change or what you're allowed to change. Now,
Right.
Just because other is in black doesn't mean you can't change it. And basically by changing any of the cells, it's not really impacting anything except that other income. So.
Right. That's all. I just wanted to make sure that it doesn't break anything somewhere else that I may not be aware of. And you know how Michael was.
No, absolutely. Because all the subsequent fields, like all these fields that I didn't touch, right,
are still independent of each other.
Adding the, I think it's adding the percentage. So yeah, it's adding the percentage, and that's all. So the 2% is added on to the previous year, and that's all it's doing.
Okay. All right, cool.
I haven't looked at everything, but I'm pretty sure that's it. And there's no other way to do it either.
Right.
No other blue field, unless you add it to the rents, I guess. But I don't think it's an issue doing that at all.
Okay. All right. Thanks.
Yeah, no problem. So yeah, we ended off at the summary tab. So we got everything filled in. And we had the rent escalator and the other income escalator, and we have everything in the P&L worked out. And we ended off here. So the last tab we were at is the summary tab. And we kind of wanted to go over some of the equity split, and we were talking about the cap rate. We were also talking about loan to cost. This field, I learned about this probably, I don't know, maybe 4 or 5 months into the DMM channel. And I didn't know what this did. And one of the advisors said that it's loan to cost. And I didn't know what that meant. And really, what it does is when you change this to yes, it grabs some of your rental budget and puts it, basically you're financing a piece of your rental cost. So about 80%, depending on, actually in this case, it'd be 75% of your rental cost, because we have a 25% down payment on this one. So it basically finances your rental cost up to about 75%. Now, will you get that from lending? That's the question. So you could change this, but it's not going to necessarily provide you a realistic lending environment for you. So this.
Can I jump in here for just a second, Mark?
Absolutely.
I will say that loan to cost is going to need to have an experienced person on your team. Loan to cost is saying, and first of all, it's going to be Fannie over Freddie, that I'm experienced, I've done this in the past, I have a number of units, here's my experience, and so forth. Loan to cost as a new person, not necessarily going to happen, especially if you're going on, obviously on Freddie. On a Freddie loan, they don't allow loan to cost.
Okay, so you would need someone with experience with Freddie or Fannie on the team in order to do that. And the debt coverage needs to be there as well. So if you do loan to cost, you have to have at least 1.25 debt coverage ratio, right?
Correct.
Okay. So yeah, something to think about, but I typically always have this at no, but I learned about that from one of the advisors. And I thought that was interesting because it completely changes, you know, the returns for the good. I mean, it looks really good when you change that to yes. But the debt, you may not have the debt service coverage. You have to, there's no cell that shows you, okay, now that you change this to yes, here's your mortgage, but it doesn't show you the debt service coverage. It doesn't change this field here, which would be nice if it would show you that, but you could probably manipulate this right here quickly to see like what your loan balance or what the debt service would be by changing, I think by changing this guy. I mean, you don't want to change any of the blacks, but I was trying to figure out like how you could get this debt service coverage to show you, you know, what it would be like if you did go to loan to cost. But I didn't want to get in the weeds on that, but because there's no fields that really tell you what your debt service is when you change this. You kind of got to figure it out for yourself. But just something to think about. I just wanted to mention that. So
that might be something that we'd ask Michael to take into consideration of adding.
Yeah, absolutely. That should be on the list. We're actually creating a list of certain things that we'd like to see, or just things that maybe aren't working right or whatever. So yeah, that could be one of them.
It looked like the debt coverage ratio changed when you switched it back to no. It was 7.75.
Where'd you see that?
When you switched back to no, went to 1.99. Down here,
the debt service where?
938 on the summary tab.
So all right, where's the debt service?
So the line 38, cell 38. 175 now. When you went to no, it went to 199.
1.175.
Debt coverage ratio.
So you changed it to no, it slipped at 199.
But why is it? So I'm on scenario 4 here. It's 1.29 here. That's the first year. This should be first year as well, right?
But that's loan to cost. Yeah.
Yeah, but the debt service, when I change it to no, it's 199.
Mm-hmm.
See, it should go, well, this is not the same as that column 4 here.
Yeah.
And I'm not sure because it's using the expenses, 50%, right? Yeah, I'm not sure. I don't want to get stuck on.
Right.
I'm sorry. What is the loan to cost? Can just quickly. I'm sorry if I missed it. What does that mean?
So
yeah, go ahead, Julie.
So in your sense, your loan to cost, if you were to put in your renovation into the loan, we would be taking 80% of that loan amount in addition the renovation costs. So if you got $1 million, you're putting in, typically you would get on $1 million loan amount, you would get, 80% loan to value. If you ended up saying you've got 1.8, now you're taking 80% of 1.8. So you are including the renovation in the loan, which is what we tried to do on yours.
If you put yes, you're or is it no? Which way is it?
Yeah,
So,
when you put yes.
Loan to cost means you're just borrowing just enough to buy the property.
No, loan to value is the property. Loan to cost includes the renovation.
Got it. Okay.
Yeah.
Okay.
Thanks.
Okay. All right. So I'm just going to go over some of the fields here that typically we see SDAs being submitted, and maybe then it's not looked at, or just things to think about that you can change in order to get the returns up. And some of the things are the acquisition fee. I always see this at 3%. And I think 2 to 3%, especially depending on the size of the deal. The bigger the deal, this number can probably go to 2%. So just to get if you're really tight with the numbers and you want to see where if you can get them the returns a little better, you can put this from 3 to 2. And then some other fields that we look at, we want the equity split to be typically 70, 75, 25. I think Nighthawk Equity, if you look at their requirements, I believe 75, 25 is what they're looking for. I'm sure that if the deal is really good and the returns are good, 80, 20 might work. If you look at the return tab and you see that returns still look really good, then that might work as well. But I think they like to see 75, 25. And a lot of times we see the capital transaction fee. As a default, I think that's either 1 or 1.5. And I always set this to 0. And the capital transaction fee is basically a transaction fee when you refinance and when you actually dispose of the property or sell. So you could change this to 0 to get your returns up. Asset management fee anywhere from 1 to 2%. So you tweak these numbers to get the returns that you want to see. And then preferred, I know Nighthawk Equity likes to see this at 0. So no preferred. If it works without preferred, awesome. You could have a deal that with a preferred maybe 6, 7, 8%. And if it works and the returns look good, every deal is different, but typically if it doesn't work without a preferred, then it's a really good deal. Because when you start putting in preferred, the returns start going up pretty significantly. So we got, so I put a 7% preferred, and now we're at 21% annual return, 1766 IRR. You go 8, changes a little bit, not too much.
Does everybody understand what preferred is? Is there anybody in the house that does not understand what preferred is? Perfect.
I understand what it is, but I've always had a little bit of trouble with the math for it. I never understood how the math is actually calculated. I don't know if there's a really simple example of.
Maybe we could look at it. If we look at the returns, let me see here. So we got an 8 pref now. We got 8% preferred. What I know it does is it takes away from the manager's compensation, and it's pretty much distributing it. Basically, what it does is it does catch up too. So if you don't have enough cash or money to distribute like the 8%, it has to catch up in the previous year. So it takes away anything from the manager's compensation because it's continuing to catch up on that 8% for the investors. See, let me see here. So there's distributions. Yeah.
It can be extremely dangerous, you guys, as a new investor to put out a pref. It's a stressful situation because what you're saying is I guarantee that as an investor, you will make 7%. And even if I can't get to it, you're going to make that. So you're 75-25, then maybe become, 90-15 because or 90-10 because you have to make up. You have to take money out of your pocket, out of your management fee and pay them. And there have been folks that have to take out of their reserve budget to pay their investors.
Yeah.
So I would say it's very dangerous. I would consider not putting it into your first couple.
Julie, can I piggyback on that?
Yeah.
When you get that preferred, when you offer preferred return, you have to remember that the preferred return is coming off the top. If Mark could go back to his P&L statement right quick, I could show you exactly what I'm talking about.
The P&L or the returns?
No, the P&L tab.
Okay.
Yeah, see right there. Okay, everyone, take a look at line 41, 42, 43, 44, and 45. Now, if you take a look at where it says Asset Manager 1, remember preferred return and so forth, right? When you have a preferred return, that comes off the top before the 75-25, 80-20 split, whatever it may happen to be. Those investors are going to get that. Now, suppose you have a bad economic downturn come, right? Your forecast you don't reach, you don't hit your forecast, right? So, but the 8% must be paid regardless. Now, if by chance you cannot pay that 8%, that 8% is carried over. There's a possibility that as that 8% is carried over, each time you don't hit it, you can start working for free because you cannot get paid. So a lot of investors are now turning away from the preferred, especially now, since they're unable to really, since the market, we believe that sooner or later, the market's going to hit a downturn. They're starting to stay away from the preferred. Because if it does happen, you can find yourself, as not getting paid, because when you do have money, you gotta dish off that 8%. And if you owe them anything from a previous year, you got to pay them that too. All right. So, and simple, that's what a preferred is. Those investors will get paid first. Whatever's left over, the 75-25, 80-20, or 70-30, that little bit of money will be split next.
Yeah, Alejandro, and look at the I'm glad you mentioned that, Daryl, because over here in this section, I wasn't even looking at this section. I was going to the return section, but this tells you that for the first 2 years, there's no cash flow for.
There's no money.
You see that? There's no cash flow.
There's nothing for the GP side, and then year 3 we start to see some money.
And just imagine if year 3 you get a downturn. That mean Mark don't get nothing in year 3 either.
Yeah. Yep. Exactly. Yeah, it's true. It's it could get very difficult if the environment, if the market's not good, and things you're not making as much on the projections that you thought. But you got to look at that too. That's why we got the SDA, right? We're seeing, okay, a preferred's not going to work here. Obviously, the GP's not getting paid. So yeah, that's.
Thank you guys. I appreciate that.
Yeah. So that's one reason why Nighthawk doesn't want a preferred. All right. So where are we at? So, okay. We still have, we like to see this at like 8%, I think now. 7 to 8 is actually not bad. 7.3 is not bad.
Mark, can I ask a question?
Mm-hmm.
On the acquisition fee, there's an acquisition fee and there's an asset management fee. So can you speak to a person on your team that has brought you the deal, especially in Michael Blanc's group? So we're all bird dogs, if you will, right? So you want to get into the deal. You brought the deal. Are you being paid a 1% asset management fee, or are you getting paid what was the other one? The acquisition fee.
Yeah, you should be getting paid up front, and then the acquisition and the asset management fee if you're working with the asset management team, the other GPs. If you're doing work, you should get a piece of the asset management fee as well. And if you go to returns, you can see what you'd get paid. So you can, I mean, in the returns tab, if you go all the way to the bottom, you can see how it all works. So let's see, right here. So for each I guess, role that you play in the deal, you get a certain amount or a certain percentage. So if you source contract, due diligence, closing, if you're part of that process, if you find the deal, responsible for most of the due diligence, I'm not sure if this is, I may have changed this, I'm not sure. I don't know if this is default, but you're getting 40% of this 5%. That's what that is. And then, Michael Blanc's team or whoever's helping you would get another percent. I mean, you could say, this could be someone else. We're talking about if you already have a KP, if you already have someone with net worth and have the ability to raise capital, you can change all this, right? And you can manipulate some of this. If it's someone else on your team, maybe you get 60% here and someone else gets 40. So you can manipulate all of these, this section over here, and depending on how many partners you have. So if you have multiple partners, if it's you and 3 other people, you need to be able to divvy up, all these funds for each section, and you can do that here. It all has to equate to 100% on each category, I believe.
So Mark, if you go back to the asset management, that's going to be paid out to one person? Is that going to be considered the person who is putting all the information into it? How do you decide that?
You have to decide that as a team. So this is like, for instance, this is the asset management fee every year, right here. Now you distribute that accordingly. So in this case, we have 2 people, let's say me and Michael Blanc's team or Nighthawk Equity. I would make $1,881 or $89 that year for asset management, and $6,300 would go to Michael Blanc's team. But
is that broken up into percentage, like a 70-30 kind of deal, or?
Yeah, it's all broken up here. So, and you got to play with it. Like I know that sometimes I play with these numbers and it still doesn't look right. Like I'll do 50% across the board and it's still not really giving a 50-50 split. So I haven't figured it all out. You got to play with it, but it's down here where you play with those numbers.
I'm trying to figure out what would correlate with the asset management based on that chart right there that you're showing.
Yeah, there's
which section correlates with
asset management. So okay. I got 50-50 for asset management. Okay. Yeah.
But it doesn't show that.
Yeah, it's not 50-50. So there's other factors in here that I haven't really played with. But you could go crazy and just, you could say
but it's
here's
only
100%.
5% of the total amount. So
50 there. I think if you did 50 everywhere, then it would show 50. Like over here is 100% partnership opportunity. So you did 50 here, and I think things start changing.
There's a partnership opportunity. I don't know what that is. That sounds like some.
See, I changed more than the asset management section, and I'm already getting a little more piece of the pie. So it's not just that asset management part. It's it's other portions of that you'd have to play with to get the right, I guess, ratio that you want. See, and then capital raising, that's huge. So if I raised $1 million, I'll be getting more of the pie. Okay, so we go here. That might change asset management as well. I don't know.
An acquisition fee too.
It changes asset management as well. It also changes.
Hey, Mark.
Hey, Mark.
Yes.
Hey, so I actually had a lot of questions about this when I first got started. And so if I remember right, the asset management fee and the asset acquisition fee are all divvied up based off of the GP percentage of each GP. Right. So it doesn't matter your limited partnership or how much you've got there. And if you scroll all the way down to the bottom, you'll see that on the GP section right there is the overall 100. And then like each one of those areas has like 15% of your GP is going to be from, what does that one say? Partnership opportunity fee right there. Yeah. Okay. So then that's split 50-50 between the student and Michael Blanc team. Yeah. Whereas you go up a little bit higher to the capital or the money raising right there. Yeah. That's going to accumulate, or that's going to be based off of how much each party is going to give, and that by itself is going to be worth 30% of the total GP available. Yeah. That's why you're like, if you go through and you're trying to get like 50-50 through each one, like 50-50 for the one that's right above it, the risk capital, that's only 5% of your total GP. So it doesn't really, it's not going to change much for you as far as the acquisition or the management fee.
Yeah.
Yes. I absolutely agree with that, because each one is weighted differently. That's 30%. Exactly. Asset management is 35%. Yeah, everything's weighted differently. So
yeah, that makes sense.
Mm-hmm.
So you just gotta play with it. Even if you did 50-50, it's really not going to come out 50-50 because of the percentage weighting. Yeah. Yeah.
Yeah. So there was a few like different strategies for us to try to find a way to. It's almost like deal sourcing. Like you go out, you find a deal, and like maybe that's all you want to do, and that'll get you like 5% GP in that deal. And then you go into like, well, maybe I want to actually manage this because it's down the street from me as well, and I can assist with that. Well, managing it is going to be worth more than just acquiring or just finding it. So you get a little bit more for actually doing work in it. You get more for actually putting up the money for it. And yeah, it's just all weighted differently. And rather than trying to attack everything, do everything all at once, you kind of get a kind of feel for where your strengths are, what you can do. If you can't raise money, then well, maybe you can find a bunch of deals. But if you can raise money, that's an excellent way to leverage things.
Mm-hmm. Yep. Yeah, absolutely. All right. So
Mark, do you spend a lot of time on that, on the returns tab?
I don't. To be honest with you, I don't. I mean, I understand it. Like I played around with it, so I can understand like how to manipulate it. But I don't spend that much time. What I do, I mean, I spend time on looking at overall returns for the GP side, and then, I mean, if it doesn't look right in terms of like, okay, if I have 3 partners, and if the numbers just don't look good, we're not going to be making that much money on the deal, then we got to tweak it a little bit. So, but not that much time. No, I mean, as long as if the numbers look good, then I know it's going to be a good deal. So I could bring it to my partners.
Cool. We were talking about this section being a little excessive, really, to start with. The intention, from what I was gathering, was that if you have 5 people that you're working with and everybody is pulling their weight equally, then you don't need this section. When it comes to your acquisition fee, you're going to split it down the middle for everybody. But
I agree to that.
In the case where you have students or you have other people that are focused on doing only one part of the deal, that's where this part is going to really help kind of break things out, and people aren't going to get overpaid for doing less. Everybody kind of gets what they're reserved.
Yeah, Yeah, and it helps distribute too. It helps. I mean, sometimes you want to see what your team will make, like each of you will make, and you can, distribute it and separate, some of the funds that way. So you could be like, okay, well, I'll be making this much per year or whatever, and then at the sale, we'll make this much. I don't know. It's just it's good.
Yeah.
Definitely good to know how much everybody's going to make.
So Mark, we have got about 5 minutes.
Oh, okay. Shoot. Okay. Well, let's the acquisition side. So that was the summary where you want to tweak some numbers, try to get the returns a little more up there, I guess. And let's see here, acquisitions. I know someone wanted to get into the acquisitions part. Now, some things that I see is lead inspection. Now, you can remove this if it's built after what, 1978, I believe. So anything after 1978, you don't need a lead inspection because there was no lead was banned back then. So you can remove that.
What was the year again, Mark? I'm sorry.
What's that?
What was the year again?
1978, after 1978.
Okay.
So that is something I see a lot, and transfer tax could get expensive. This is always one. So by default, it's 1%, right? I was underwriting in Florida, and theirs was I think it was like it was either 0.75 or 0.65, something like that. And it saves you, closing costs of like $20,000. So find out what the transfer tax is. It could save you some money. And it's usually, I think 1% is the rule of thumb, but it's usually below that.
Mark, how do you find the transfer tax?
I spoke with, I think it was in Bradenton, and I spoke with the county, I think it was the county clerk or the assessor's office. I forgot where I got it, but I asked and they told me, I think it was 0.75.
Do all cities, counties, states have transfer taxes?
What's that?
Do all cities, states, counties, governments all have transfer taxes?
I don't know. And I don't know if this lookup actually works. I went to it before, and I don't know, where does it bring you? Oh yeah, it brings you to
Midwest is
like a login.
And every state in the Midwest is transfer taxes. So
yes.
I don't know about the West Coast or the East Coast or Southern states, but in the Midwest, there's transfer taxes.
Yeah,
for sure.
So the other thing is the reserves at closing. So if you're doing Freddie and Fannie, I think it's 9 months of debt service, right, Julie?
So for Freddie, it's 9 months of debt service. On Fannie, it's 10% of the loan amount.
10% of the loan amount. Okay. 10%. So that'd be really.
Mm-hmm.
This is the loan amount on this one. 55.4 million. So 540,000.
That doesn't seem right, does it?
No, that would be way too much.
$1 billion.
Hope not. Anyway, so that's something to think about too. And we typically put, what is it? By default, you're putting 1,000 per unit, or 2,000 per unit as reserve, just as default, even if you're not doing any renovation costs. Because right here, let me see. Yeah, 1,000 per unit, and then 1 month's income. So it might not be 1,000 or 2,000, but in this case, so if it's 9 months of debt service, this is 318. So 9 months would be that divided by 12 is 26. So then times 9, 239,000. So I think that's Freddie, right? 9 months of, is that what you said?
Correct. Yep.
Okay. So 239,000. So that's things to think about if you're going with Freddie and Fannie, you're going to need reserves. That's one of the reasons why, this SDA has a rule of thumb of adding at least 1,000 per door and 1,000 1 month of income. But that, I don't even think that will cover the 239. So it's going to be, but we're doing reno. So I'm not sure.
That's liquidity. That's liquidity.
Liquidity. So it
liquidity.
doesn't. Okay, so it doesn't have. It could be like a KP or someone in the team that has the money.
Absolutely.
Okay, so it doesn't have to be in like some escrow.
No.
Also, you're saying that does it have to, can it be combined or does it have to be?
Yes.
One? Okay.
Nope, it can be combined. Yeah, both net worth and liquidity can be combined.
Okay. Right.
Okay.
So for Freddie, it's 9 months, and for
correct.
Fannie, it's
10%. That's what we always quote.
10% of liquidity. So we don't
10% of the loan amount.
Not like we have to raise it. We just need 10%
Show it
in the GP side.
Correct.
Okay. Okay. That's good. That's good to know.
Mm-hmm.
And then if we have, like, I don't know what they keep that separate too, the rental budget, right? They don't look at the rental budget as anything but rental budget. They don't look at that as a reserve or anything. I'm just thinking like, okay, if we have, if they're looking for us to have like some reserve, I was just thinking like maybe they see that we have a rental budget of, $750,000 that kind of helps with their reserve requirement, but maybe not.
All right, Mr. Mark.
All right.
We have to wrap this up.
Okay.
One quick question, Julie. The 9 months, it's 9 months of
debt service.
Debt service. Okay.
Yeah. So that's debt service right here. So it shows you in the SDA what the debt service is for a year.
Right.
So you just calculate 9 months of whatever this is. So are we? There's a lot to the SDA, but I think are we good?
Do we want to take a break? Do we want to go one more week? What do you guys want?
Go one more week for doing what?
To go through the SDA to make sure that everybody understands it.
Oh.
Nate, you haven't been here, so
we'll
get up and start. Yeah, that's good.
I caught up, and that's why I caught
That's
up.
awesome.
Yeah.
Hey guys, this is Devin. I'm curious, how much more content is there? I mean, like how much more could we get into next week? I'm very interested, and I'll be here on the call regardless of which. And I would like to. It's a definitive goal for me to master the SDA. So anything more that I can learn about it, I'm absolutely willing.
Let's do. Can we do 5-10 more minutes, Julie? I just want to go over a couple because I don't know if we do one full session, but I think this exit strategy.
Right, that was what I was going to say. Exit strategy.
What if we do exit strategy next week?
All right.
The goal is to stay, to finish up by 6, you guys. 9 o'clock. I want to be respectful.
Okay.
We got 2 minutes.
So why don't we just plan on you coming back and speaking next week. And we can also talk about other topics next week. Just kind of have a free-for-all. How does that sound for you guys?
Exit strategy and then free-for-all, because I just want to, this is important because the exit strategy can make or break a deal, kind of. I mean, for sure.
I would like to talk about assumables because that's a big thing that's going on now. People are offering assumptions on the loans as a strategy. A lot of sellers are doing that from what I've been seeing.
It's not a good strategy right now.
Yeah, but I'd like to know how that plays in with the underwriting. And
that's great. And how we can input it.
Yeah.
I think that's a great idea.
Yeah.
So let's do that next week. Mark, what are your thoughts on that? Mark, can you speak to that next week?
Assuming a loan? I don't,
or a bridge loan.
don't know how to underwrite that. Like, I think what you do is you have to do like a secondary mortgage, right?
Right. I mean, you'll do a bridge loan on a second. You assume the first, but then you have to do a bridge loan on the second to cover the difference.
Yeah.
But just from a lot of brokers, I'll get the OM and it'll have scenarios that'll say the terminology will be the assumption and non-assumption, or it'll be some kind of, and I'm just like, I don't know how to underwrite this. So I get kind of frustrated trying to do it.
Yeah, that's a very valid question. And I think we should address that next week. Mark?
I'll try to address it.
Yeah, I can send you an example, Mark, from an OM that I've got, and you can look at it and just kind of.
Yeah. If we have an example, maybe we could.
I'll send you.
All right. Well, I'm gonna wrap this up. The rates are dropping, you guys, like hotcakes. So we've seen 70 bip decrease in rates over the last couple weeks. LIBOR is at 1%. It was at 250 a year ago. We're at 1. So this is going to affect the way that you're underwriting, what you're seeing, a lot of assumptions, but be on the lookout. I think Nate brought up a great idea to look at assumptions, because that's what's going to be coming down the pike with opportunities, because a lot of yield maintenance in place and people are going to need to get out of those loans. So how do we underwrite that? I think it's wonderful. So let's address that next week. Bring a friend. And as Lou Holt says, 3 things: do the right thing, do everything to the best of your ability, and 3, show people you care. So with that, I'm going to wrap it up. You guys have a great week. Do your best, and I'll see you next week. Zoom at 8. Thanks so much.
Thank you.
Thank you.
Thanks, Julie. Thanks, Mark.
Thanks, guys.